Good morning. So oil prices are back up. We're above $75. We were there earlier this summer. And we had a little bit of a retreat about a month ago, down around $8. And why was that? It was because heading into the summer, we had very bullish expectations in the market because OPEC wasn't increasing supply and demand was flying. Unfortunately, the Delta variant hit demand in Asia and most noticeably in China, which has been driving this post-COVID recovery. And as a result, we had a bit of a fall in the market, but now we see that China is buying, as IDEX said, India is buying, and we have production outages, most severely in the US Gulf of Mexico, where we've had the greatest impact of a hurricane ever in terms of actual production facilities. We've actually had refineries come back up, which has not been the case historically. So that has created real tightness. We also have Nigeria having had an oil spill in Forcados that is also holding back production when Nigeria is meant to be ramping up as OPEC has agreed to increase production 400,000 barrels per day, month on month through the first quarter of next year. So, where are we versus COVID's buildup in oil stocks? So here we're looking at OECD inventories. So these are the most visible inventories we have in the world. And we can see the 5-year average in the first bar chart. And then we saw how much we built up in the first 2 quarters of 2020. Already in the third quarter, we started to draw down, and this is because China came out of the COVID crisis much faster than the rest of the world. And we have drawn down now below the 5-year average. So we're done. And this is despite the fact that we've had to revise down demand expectations by 1 million barrels per day in August versus where we thought. So the market is in a very good spot. Now, despite that, OPEC is most likely going to stall output increases in the first quarter because they and the IEA believe that there is going to be a demand collapse in the first quarter versus the fourth quarter. In our view, they're a little bit too bullish on the fourth quarter, and so they have made a tough calculation in terms of the first quarter. They also seasonally always expect less oil in the first quarter. But to give you perspective, OPEC thinks that there will only be 100,000 barrels per day additional demand for their oil in the first quarter of 2022 versus the first quarter of this year when they announced their massive cut and an extra 1 million barrel per day cut by Saudi Arabia. The IEA is a little bit more optimistic. They see 600,000 barrels per day more demand versus that 100,000 barrels per day demand. We, on the other hand, have a much stronger call on OPEC. And this is where, in our pink arrow on the right-hand side, we actually see demand increasing, and OPEC should bring back more barrels into the market. So the best is yet to come. This rise, when we look at that first quarter, it's a 3 million barrel per day rise in demand versus the first quarter last year. So there is a huge disconnect here. And we have OPEC output rising, despite the fact that they will not likely increase production because they will stop having these outages, we hope, in Nigeria, under production, in Angola, and places like that. So when we look on the middle of next year, so the second and third quarter, which is when we get that demand boost versus this year, we see a 2.5 million barrel per day rise in oil demand. So it paints a very bullish picture for next year. Now, when we look at our balances, we actually see 9 quarters of draws. So we had that massive draw in the second quarter of 2020 from COVID. And then we're right now, we're right in the middle. We forecast that, in the third quarter, right now, we're drawing about 2 million barrels per day, and that is contributed to this $75+ oil price. But we see small draws continuing through the third quarter of next year, and then the fourth quarter has a little bit of a build. And why is that? It's because U.S. shale is absolutely coming back. U.S. shale has been prevented from rising this year because they hedged oil production a huge proportion at $48 a barrel. So even with WTI trading at over $70, they're not getting the upside. So what is next for oil prices? Now, analysts are very split. Some are talking about the $45 to $60 range because shale is coming back, OPEC has spare capacity. Others are talking about $85 to $100 plus. Now, this summer, heading into the summer, there was a very strong case to be above $80, but we didn't break it. Part of it was fundamentals with China, and part of it is that the market has changed. We don't have the cost inflation we've had in the past, and we don't have pension fund money coming in like we did in 2008 into the oil sector, and we have savvier investors that want return on their capital and that are concerned about demand destruction. Moreover, when we look forward, OPEC still has spare capacity of 5.5 million barrels per day. So we have this very tight market right now, but it is by choice. Now, of those 5.5 million barrels per day, 2.5 million are sitting in Saudi Arabia. Then we have, if we add in Kuwait, UAE, and Iraq, that's how we get up to 5.5 million barrels per day. Now, when we look at next year, it drops to 3.8 million barrels per day because it will increase production over the course of the year. But Iran will change things when they come back. They will bring on 1 million barrels per day of production quite soon. So they will take up a lot of that growth in the call on OPEC when we look further out. But what do we think about the price in the next 3 years? Well, we expect OPEC to continue managing the market because the market is very happy with $70 plus range, between 70 and 80. We're not seeing demand destruction. Demand is fantastic. We're seeing production. We're seeing fantastic cash flow returns. And so we forecast $75 for next year, although the second quarter is going to be amazing. $78 the next year because we will have had our 9 consecutive quarters of stock draws, and then $70 for the next year, because that's when we start to see the real effects of substitution away from oil, especially in the transport sector. And then our long-term price continues to be $60, but that doesn't mean that this is the last cycle or upcycle or super cycle. The real super cycle is yet to come. And that is because historically, the way we had decided what is the supply coming into the market, if my long-term oil price forecast were $60, I look at what can be produced for $60 a barrel. But now projects are being sanctioned at sub $50 a barrel, at $45 a barrel. That is taking out massive amounts of acreage out of the potential supply chain. Moreover, companies are prioritizing short cycle investments and things that are near existing infrastructure. So as a result, we get a huge imbalance between 2025 and 2030. Now, it's too difficult to say right now which year it is, but that is when we will have that huge upswing again. Thank you.